Hello everyone and welcome to the another series of Principal Connect. Today we have Mr. Ravi Gopalakrishnan, Head of Equity for Principal Mutual Fund with us, and he will share his perspectives on economy, market and the investment opportunities. So welcome Ravi to the Principal Connect.
Thank you so much, Gaurav.
So Ravi, we are at this point of time where I would say a trinity challenge. On one side, we have a slowing global economy. On the other side, we have a domestic economy which is slowing down, and we are seeing across whether it is urban or the rural demand which is slowing down, various variables which are coming down, and then we have RBI forecast also now in the monetary policy which is forecasting for a slower growth than what was expected earlier. And then we have geopolitical tensions which are emerging. So what is your assessment of this overall situation of a weak global economy, weak domestic economy, and the geopolitical situations which are emerging right now?
Sure, I think it's very pertinent to understand the situation where we are and accept the fact that the economy is definitely slowing down globally and as well as for India. But if you kind of put these things in perspective,
okay,
in terms of where we were and how things have shaped up so far, quite frankly, you can look at India from a very advantageous position in the light of all of this. Primarily because unlike people tend to compare the situation is 2008 and say draw a parallel, etc. But that's completely not correct, because today if you look at the inflation situation in India, we have a benign inflation situation. Interest rates are low and they are coming down further.
Correct.
Commodity prices, especially oil and a lot of commodities. In fact, almost 40 to 45% of the large cap companies depend on commodities. So their earnings, etc., will be largely dependent on how commodity moves, and they are all becoming soft. So while all of this is happening across the world, our currency is also stable. India, to me, is coming in a sweet spot at this point in time.
Okay.
And I'm not saying this. I mean, this is what data is saying, right? Similarly, if you look at the currency, it's been remarkably stable.
Correct.
For the last several months, despite all what is happening around the globe. And you referred to the geopolitical situation and primarily between the US and China, the kind of standoff that is happening right now.
Correct.
I think there again India stands to win, because a lot of global manufacturers, particularly from the US, will want to now diversify their manufacturing capabilities. And I think if India, has to seize this opportunity with both hands, with a stable government at the center, with stable macroeconomic policies, and also more importantly, stable taxation, which has been, some bit of debate, of late since the budget. If we were able to fix all of these, then I think India can attract a lot of capital, over the medium to long term.
Okay, but I think so. You talked about in terms of capital, and today we are in a scenario where if you look at the global liquidity, that's tremendous global liquidity which is available. Interest rates are very low. In fact, more than $13 trillion are invested in the securities which are yielding negative yields. But on the one hand we have this magnificent opportunity. On the other side, if you look at in terms of July, we have seen FIs flows being negative, and there have been more outflows. So how do you correlate these both of these?
Right, that's a very interesting point, because while liquidity is abundant,
correct,
let's keep in mind that liquidity has got no emotions, and it will always look at opportunities. Currently, and if you look at the year-to-date numbers of FIs, I mean, except for 2 months, I think January and July, I think the numbers have been broadly positive. I think we have about 70,000 crores of inflows that have come in. Domestic liquidity is reasonably okay. I think domestic institution investors year to date have invested about 17,000 crores. So net, there is a positive liquidity that is coming in, but off late, there are the taxation issues that I mentioned. One of the factors, the slowing down of the Indian economy perhaps is also creating a roadblock in terms of attracting more FII flows. But broadly, if you see, most emerging markets have actually seen negative flows in the recent past, and India is not alone. Because India has received a huge number of large amount of funds in the last 4 or 5 months or year to date, I think those flows are looking a little elevated.
Okay.
On a relative basis. But it is not unusual. I mean, one has to look at long term, one has to look at the net flows, what we will see by the end of December. And I think, if corporate earnings manage to recover, which my view is that in the second half, you will see corporate earnings, at least stabilizing and seeing a recovery mildly. Then I think, the flows can come back. Like I said, flows are not emotional. And they will chase growth, and I think apart from India, I can't, and China possibly, I can't think of any other economy or corporate earnings story anywhere else. So I think by default, India can attract a lot of fund flow. If, like I said earlier, they can fix the macroeconomic slowdown quickly, and at the same time, fix these taxation issues as well.
Okay. So another aspect, Ravi, which is there in minds of a lot of our investors and partners, is that if you look at the market performance, and now, whether there are more declines than advances, sector by sector they are in red, and across, it's not only now limited to small cap and mid cap, but even large caps have started correcting. We have seen a concentrated rally, but even in that concentrated rally, some of the stocks which are holding the market, we have seen that they are also started declining. So we have an environment where there's a lot of negative news which is coming in on the economy side. On the other hand, we have in terms of the market performance, everything is whether it is large cap, mid cap, small cap, all in red. Even some of the few stocks which have witnessed rally, they are negatives. And we have a situation where last 5 years we have a single digit corporate earning growth, and every year there have been estimates, but we have not been able to witness that. So in that situation, I think what we are looking at in terms of what is your case of investment and where you are looking at investment opportunities.
Right. So my take on all of this is in the last 25 plus years that I've been witnessing this market. Stock markets usually bottom out before the economy does. It's usually ahead of time. And as they say, it's darkest before dawn.
Correct.
So I'm not alluding to the fact that we are looking at a recovery or something like that. I think bringing in the stability is much more important right now in terms of the markets. And I think with the correction across the board, we are getting into a very healthy investment horizon.
Okay.
In terms of timing as to when the market will bottom out, in terms of how long it will take to recover is debatable. I think your assessment is as good as mine. But having said this, if you look at one guiding principle I typically look at is the difference between the equity yield and the bond yields.
Okay.
Over the last 4 or 5 years, if you look at the way the yields have been moving, equity yields have actually gone up from 4.9 to about 5.9.
Okay. And this is in which period?
About 5 years horizon. Whereas bond yields have actually corrected from 8.3 to currently about 6.4, maybe even lower.
Correct, in that range, yeah.
Right. So, in that sense, as an asset class, equity is becoming much more attractive than bonds.
Oh, that's a very interesting perspective.
Right.
Yeah.
If you look at it the other way, from a PE perspective.
Correct.
Right. PEs of the equity markets have actually contracted from roughly 20.6 or thereabouts to about 17 now. And contrarily, if you look at the bond market price earnings multiple, they've actually expanded from 12 to about 15 and a half. So that tells you that on a relative basis,
Correct.
equity markets are becoming much more attractive. Can it get more attractive? Perhaps. But it tells you something that, when the markets are down, when the economy is still down, when price earnings multiples are correcting, I think it makes a good case for people to increase their equity allocation. Rather than being, extremely defensive and extremely bearish at this stage.
Oh, interesting. So you are saying there is a case to be more biased towards equity and overweight equity at this point of time.
Well, from an equity allocation, equity debt allocation perspective,
correct.
It doesn't help at this point in time to become bearish.
Correct.
I think it's a good idea to kind of increase your equity allocation over the next few months, maybe the next 3 to 6 months, and wait for a recovery, because that's how the long-term wealth creation happens.
Okay.
Because if one were to wait out for things to improve and see a blue sky scenario and then try to invest, you are not going to
those
get
prices are not available.
You are not going to get the market or some of the good companies at 30% lower than 30% discount or whatever.
Okay. So very interesting perspective, Ravi, which you are sharing. But so even when you look at in terms of what you are saying is that equity market is much more attractive than what it was 5 years back or 4 years back. So given that situation from a investor's perspective and partner's perspective, and they are recommending. So in terms of market capitalization, where you see the opportunity between large, mid, and small cap, where is the larger opportunity which you see?
Right. I think that decision is generally, I'm speaking your language, saying that it depends on the risk return profile of the investor. But I'll answer this question in a very different way.
Sure.
Typically, when there is a rally, after the market bottoms out, the large cap leads the way. This is followed by good quality mid caps, and then mid caps, and then small caps, and so on and so forth.
Okay.
Right? So similarly, I think one has to position the asset allocation in such a manner, given the risk return profile, which is why we have bouquet of funds, right, to cater to each of these specific group of investors. To put it differently, if I were to look at the mid caps relative to large caps, mid cap valuations, right, in terms of the Nifty, the broad market Nifty, was trading at about 40% premium beginning of January 2018.
Correct.
Today, that 40% premium has turned to a roughly 14% discount.
Oh.
So, which means a massive correction has already happened in mid and small cap category. Value is definitely emerging in certain pockets, even in quality names. So, from an asset allocation perspective between large and mid, I think a bottom-up stock selection, methodology perhaps will work much better in these kind of environment. So I am actually seeing a fair bit of those kind of opportunities, both in terms of large cap as well as mid caps.
Oh, fantastic. So, Ravi, in terms of where, are there any sectors particularly where you're seeing these kind of opportunities emerging, or it is more broad-based?
Right.
What's your view on the sectors particularly?
Yeah, I think, even overall, I think it'll be difficult to pinpoint that because the tailwind is clearly missing across all sectors.
Correct.
But there are individual opportunities within each of those sectors.
Okay.
So I can give you a perspective of how our funds are placed.
Yeah, sure.
In terms of positioning, I think we are overweight the banking and financial segment. We are overweight the construction segment, particularly the cement segment. Where actually the growth, although the numbers have been a little weak, but certainly I think in terms of corporate performance, companies have done a fantastic job in terms of controlling costs, etc.
Okay.
So EBITDA per ton in terms of the cement sector has been improving.
Okay.
Over the last few quarters. So these are pockets of strength. In terms of certain underweights, if I may point out, I think the auto sector continues to remain, under a lot of pressure. This is perhaps, some bit due to the demand and probably the high base of the last few years, because the sector has been doing well. So probably, some bit of fatigue is being witnessed. But more importantly, I think it's the NBFCs.
Okay.
The problem surrounding the NBFCs. Because, let's not forget, almost 60 to 70% of the purchases done on finance. So if that liquidity kind of dries out, or people are not getting financing as efficiently as they used to, obviously there is a slowdown. But again, having said this, I think the consumption sector's cycle are relatively shorter. So you can see a turnaround also, which is why I'm not kind of giving you a very straightforward answer that this is some sector. Right now we are kind of underweight, but then we are, closely looking at opportunities, because the largest company in the sector is down 30% or 35% from the top. So I mean, these are some of the kind of, opportunities that one might want to look at, from a long-term perspective.
Sure, Ravi. And given this your perspective on economy, markets, and various sectors, which are your funds which you will recommend to our investors at this point of time, and partners to recommend, which are suitable at this point of time?
Right. So I think despite the equity culture being spreading very nicely in the last decade or 2 decades, I think equity ownership is still very elusive. I think very few people own equity.
Correct.
Bulk of the money is still lying in bank deposits. So I think for first-time investors, people, and with
Yes.
interest rates
Coming down now, I think that's
right. It makes a phenomenal case for people to invest at least 10 to 15% or 20% of their wealth in equities, in the form of maybe a balance fund or equity savings conservative products,
equity funds,
right? For the more evolved, kind of investors who can possibly take slightly more risk, maybe a small to mid cap kind of asset allocation could be good, because like I said, it all depends on the risk appetite of the investor. So in case, because eventually, from a 5 to 10 year perspective, mid and small caps will give you, very strong returns, but one has to be very patient in that. You cannot, and an SIP kind of, investment methodology will really work well.
SIP or STP.
STP also, correct.
Yeah, sure.
Also will work extremely well over there. So I think, and if you want to be slightly more conservative, then perhaps a multi-cap kind of a structure where, the funds themselves, the fund managers themselves,
correct,
allocate between large and mid-cap depending on the opportunities.
True. Yeah. Sure. So thank you so much, Ravi, for your insights, and I'm sure that will be helpful to our investors, customers, and partners. So thank you very much, Ravi, for sharing your perspective.
Thanks a lot, Gaurav, for having me.
Thank you, and happy investing.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.